Hi everyone, it's Matt here from Sharp Medical Accounting. Thanks very much for joining me today. This is podcast number 1 that we're delivering, hopefully a series of these to follow. For those of you who are aware of Sharp Medical, of course, we're a firm of accountants looking after doctors across the country. We've been trading since 2011. And I guess you'd say that our typical client is an NHS doctor with a PAYE source of income and perhaps a private practice as well. And the message I get from doctors day in, day out is they say to me, Matt, we want to be able to optimize our tax position, be smart, but at the same time be sensible. We don't want to be rubbing the HMRC up the wrong way here. We want to do things that are within the rules, but at the same time, we want to take advantage of what's there for us. And I think one of my main jobs in the firm is to help doctors to identify where their tax inefficiencies are and perhaps open up some doors to allow them to make better decisions going forward. So what I thought we would do is, throughout this series of podcasts, rather than talking about detailed tax rules, which is a dry subject, yeah, of course, and often difficult to implement in your own structure, what I thought we'd do instead is look through some hypothetical scenarios. So classic cases of what issues doctors are facing in 2024 and how they should approach managing the situation. So as you will appreciate, this podcast and none of my future podcasts can be taken as advice for you personally. This is just a generic overview which might stimulate some ideas for you to either bring to my attention or your own accountant's attention, depending on who you are watching us today. So let's first do our first run through, and the first scenario is looking at an anaesthetic doctor who is established in the NHS with a limited company. We'll just share the screen and see what you think to this. So hopefully you can see my screen now, and we've got some facts which I will run through. Dr. Jane Smith is a consultant anaesthetist working 10 PAs in the NHS. Due to waiting list initiative income and hefty property profits, her total taxable income is 180,000. So we're saying here that the P60 at the end of the year, plus Jane's profit from her buy-to-let property, she's landing on £180,000. So of course she's paying tax at the highest rate. Yes, she's lost her personal tax allowance as well. But crucially, and this really is the crucial point in my opinion, she's below 200,000 for pension tapering purposes. So at this point, Jane's thinking, I'm in a good spot when it comes to pension. I'm guaranteed the full £60,000 pension input allowance. I don't have taper. So let's just keep in the back of our minds as we go forward here that Jane is currently well protected when it comes to annual allowance. Jane is contributing to the NHS pension scheme via payroll and is mindful of annual allowance tax charges. So Jane's one of these people where she's established in the NHS, she's doing the NHS work, but she's hearing from all of her friends that the annual allowance pension tax charge is the bit that really hurts. And she's got that at the forefront of her mind. In addition to a busy NHS schedule, Jane also has a limited company through which she provides her private medical practice, and the company's called Anaesthetic Doctor Limited. She owns 50 ordinary A shares in the company, and her husband Mark, he also owns 50 ordinary A shares. So given that shareholding structure, we can be sure that the standard setup here is when a company dividend is paid, half of it goes to Mark, half of it goes to Jane. Jane, being the high rate taxpayer that she is, will pay 39% tax on dividends. Mark, a retired accountant, has a personal income of 24,000 per year from pension. So what we have here is we have a situation where one shareholder, Mark, is saying, I want to take these dividends because my dividends are taxed at just 8.75%. I'm a basic rate taxpayer. Dividends to me are ideal. But Jane's saying, whilst Mark gets his dividend and he's happy, I'm unhappy because I lose 39%. Furthermore, whilst Mark is enjoying his tax-efficient dividends, should I say, Jane is saying to me, Matt, I'm getting close to 200,000 for pension tapering purposes. These dividends are pushing me too close. I do not want to trigger pension taper here. So on one hand, I want Mark to have the income, but on the other hand, I'm worried that I'm going to get too close to 200k. You imagine the combination of 39% tax plus a pension tax for Jane. It will outweigh the advantages of giving the dividends to Mark. Anaesthetic Doctor Limited, it's an established private practice actually, with post-tax profits of £80,000 per annum, so revenue less costs, less corporation tax. This company has matured and is consistently generating 80 grand a year. At the most recent year-end date, the company had accumulated reserves or accumulated profits of 180,000. So what this broadly means is, since day one of business, the profit in the business has been £180,000 greater than the dividends taken. The £180,000 has just stopped in the company bank account or represented as investments or computers or electric cars, and they have just not paid those dividends out. So we're getting this feel, or I would be getting this feel at this time to say, well, hold on a minute, this anaesthetic doctor who's got a low-earning spouse, who's well established in the NHS with the pension taper concerns, is living well within her means. The fact that she's got £180,000 surplus reserves tells me that this person is not going into the company bank account day in, day out just to keep the show on the road. She can afford to hold money back in the business. Jane and Mark wish to achieve two financial goals in the short to medium term: reduce their mortgage debt and provide their children with private schooling. To date, profits have been extracted from the company using a combination of salary and dividend payments, standard really. But all along, whenever a dividend has been paid, Mark's been happy, Jane's been anxious. And they say to me, Matt, what can we do to enable us to get closer to reaching our financial targets? We want to get rid of this mortgage debt that's interest bearing and psychologically a burden to have as well. After all, Mark is retired now. And at the same time, we need to regularly have access to good cash flow so that our children get the best education. One route, of course, is to stick as you are and take salary to Mark for the work that he does in the business and pay dividends 50-50, take it on the chin, very, very low risk as far as HMRC are concerned, and maybe you cap the dividends at £19,000 per person so that Jane does not taper her pension. That would be the starting position, I would say, and for many doctors that will be more than good enough because they avoid pension taper, they give income to their lower earning spouse, no complexity really. But 19,000 each is only half of what the annual profit is. And there's already £180,000 sat in the bank. So where are we headed here? We've got a situation where these two are going to be working their socks off, piling money into a company, and because of tax restrictions or the pension taper restriction, they will not really be able to put this money to good use. So on one hand, they're having to pay a mortgage and pay their school fees, and on the other hand, they're scared to death of paying dividends. So what can we do? Well, what I'm about to suggest to you here today is certainly not risk-free. I mean, having a limited company is not risk-free. Paying dividends to a low-earning spouse is not risk-free. Doing private medicine as a doctor is not risk-free. But just so that we understand what options are on the table here, we could look at what we call an alphabet share structure. And the alphabet share structure aims to create a situation where dividends can be paid to Mark but not to Jane. Mark is on £24,000 a year. Ideally, we'd like to get another £25,000 per year to him as a dividend to utilise his basic rate tax band. He's paying tax at just 8.75% after all. But we know by giving him 25 grand at the minute, we have to give Jane 25 grand, which is problematic. So what we could do is we could go through the process of restructuring the ordinary share capital so that Jane owns A shares, so continues to own ordinary A shares, but Mark takes on board 50 ordinary B shares. That capital transaction has to be done carefully and with professional input. Not to be rushed, not to be taken lightly. It needs to be done well. And we're trying to create that situation where, on one hand, Jane owns 50 ordinary A, Mark owns 50 ordinary B. Then what we can do is we can say to ourselves, well, what do we have here over and above just two shareholders in a company? Well, something that's critical from a tax perspective, those ordinary B shares that Mark now owns, they must be more than just a right to income. Otherwise, we end up getting into hot water with the revenue, because they will say, hold on a moment, this isn't truly an investment. He's just got shares to be able to receive dividends from a company at low rates. It's just an income stream. So we must make sure that those new shares, those ordinary B shares, give Mark not only a right to a dividend, I mean, that is important, of course, but also the right to a vote, albeit quite hypothetical, isn't it, in a limited company owned by husband and wife. But nevertheless, the shares have to have voting rights. And Mark also has to have the right to access surplus capital. So when the business liquidates, he has to have the right to take his share of the distributable reserves. It can't just be a shareholding to give him dividends. He has to have a say. He has to have the ability to be a problem, to block decisions, etc. It's more than just a right to income. Otherwise, HMRC would say, no, we're not having this. This is an artificial contrived arrangement. But if we do it well, we get ordinary A and ordinary B in place, we could potentially see a situation where, of the £80,000 that's made every year, £26,000 per annum is paid to Mark. He receives it at 8.75%, taxes it through self-assessment. He can put that cash towards the mortgage debt and the private schooling. He might go further. He might say, Matt, I'm not bothered about the higher rate of tax. For dividends, it's only 33% anyway. It's not like 45% or 40% with salary. He might say, well, take my income from 24 grand, my pension, and get it all the way up to 100 grand with dividends. Jane doesn't want anything really, just me. And I accept I'll pay tax, but at a lower rate than Jane would do. That is also an option. It would allow them to pay the mortgage off sooner. It would probably allow the school fees to be paid a little bit easier as well. But something we have to be desperately careful of here, and it's an area that I've been reading a lot about recently, just simply because many of our clients are going down the alphabet share route because tax rates are so high at the moment. We have to be careful that we don't create something called a bounteous arrangement. In other words, when, in this example, let's say we've got the 50-50 A and B. When we pay the dividend to Mark, we have to be sure that the profit that's left in the company after his dividend is enough to furnish Jane with her dividend if she had wanted it. So let's have an example. We're saying here at the most recent balance sheet date, there was 180,000 in reserves, plus another 80,000 profit from the new year. So £260,000 profit in reserve. I am saying to you here today that in order to minimize risk and in order to potentially reduce any chances of being accused of creating a bounteous scenario here, we would cap Mark's dividend at exactly half of the distributable reserves. So £180,000 brought forward plus £80,000 profit is 260. Half of that is 130. So I'd be saying to my client here, give the dividend to Mark, but no greater than 130,000. And then what we can say to ourselves is, if HMRC question this as being some sort of arrangement, it isn't, because the £130,000 that would otherwise have been paid to the A shareholder Jane, it's still in the company. It's sat there. So that is a really necessary step to take. And this works along similar lines with dividend waivers. Some of you will have come across this, where one shareholder decides to waive their entitlement to a dividend, what we must be sure of there is similar. We have to make sure that by waiving the dividend, the higher rate taxpayer does not create more reserves for the lower rate taxpayer. We have to keep those reserves up our sleeves to prove that we could have paid it, Jane, if we had wanted to. This scenario that I described to you here today, the ABC or alphabet share structure, could potentially be used with other shareholders. It doesn't have to be spouses. We could be looking at adult children, parents, but all of the same principles apply. And my point here would be, we also have to make sure that it's commercially realistic. I mean, ultimately, we have tax rules to work by, and we live by them. But at the same time, HMRC, they do have the powers to say what's the commercial reasoning behind this transaction. Why would they do that if it was anything but tax driven? So, in Jane's example, it might the argument might be that Jane is more of a pessimistic person than Mark. She doesn't want to take her dividend simply because she's unsure about the future of the private medical sector. She's concerned about a claim against the business, whereas Mark is less concerned. But there has to be more to it than just a tax advantage, and avoiding the bounteous arrangement is crucial. That's my first run through of a scenario for you, just to give you a recap on what you should consider here in terms of the headlines. So first of all, if I was a doctor, I'd say to myself, what's my marginal rate of tax? What's the marginal rate of tax of my fellow shareholders? Secondly, I'd ask myself, am I close to any dangerous tax thresholds, such as pension taper? Then I would say to myself, what is the shareholding structure in my business? And what does that mean in terms of dividend payments? How does that dictate the dividend payments that I make? I then say to myself, I've identified the marginal rate of tax, I've understood my shareholding structure, I now need to understand what retained earnings are in that business and how much I could potentially pay with that bounteous element in mind. And when I've collected those facts, so I know my reserves, I know my structure, I know my marginal rate of tax, I'd be saying to my accountant, does this apply to me? Can I make this work? And before you do it, you would say, let's be absolutely sure of the risks. None of this is risk-free. HMRC could look at any of this just like they could look at anything else that you do in the tax world. This is podcast 1 done and dusted with. I hope it was helpful. Maybe it stirred some thoughts amongst the listeners here today. If you have any questions, do get in touch by all means at matt@sharpmedical.co.uk or give the office a call. For the time being, though, thanks very much for listening, and we'll be back in touch soon with another scenario. Bye for now.